afternoon, everybody. My name is Matt Schlyder from Elliott's, and welcome to the second of my webinar series on incorporating your legal practice. Today we're going to spend some time looking at the implications of incorporating your practice for the principals of the firm. So just a quick introduction. I'm a chartered accountant. I specialise in working with lawyers and law firms to guide them to achieve their goals. I had another webinar a month ago and I was overwhelmed by the feedback and the acceptance of the offers that I made to discuss practices with the principals of those practices around the issue of structuring. In running that webinar, it really confirmed for me that there is a significant complexity around this issue for lawyers and law firms. In addition, it showed me the variation in the understanding in your industry of all the different and varying rules that apply to this topic if you were to consider a restructuring. And also the variation that exists in terms of how businesses are structured. So just to get us underway, I thought I might just do a very quick poll just to get a bit of an idea as to who we've got on the webinar today. So if you can just take a moment to just pick what best describes you. So we're almost there. Couple more seconds. So in terms of the participants on the poll today, we've got about 28% of sole practitioners, 38% are partnerships of 2 to 3 principals, with 21% being a partnership of 4 or more, 7% of practice managers or CEOs, and 10% other. So welcome everybody, and I hope out of today you'll get some more information. For those who attended our my first webinar, we're going to be adding on to some of the overview that I provided in that seminar. Just to give you a bit of a context around where an ILP sits from an individual's perspective. So remember, we're talking today about principals of firms. I ran through this last time, but for anybody in developing their strategic plan from both a personal and a business perspective, you need to get really clear on what your financially well-organised strategy is, and that is around getting clear on your goals and objectives. The green area there is making sure you've got a strong foundation in place for the future, and then the points 7 to 10 are really around driving your strategies to achieve your goals. So from a personal perspective, when we're looking at whether or not you should incorporate your legal practice, we need to consider these things: your goals and objectives, an asset protection plan, taxation issues, your debt management. Then what that means in terms of your ability to retire, so have enough assets to get to a point where you can make a choice whether or not you want to work, how it impacts on your business, and also your superannuation strategy. We're not going to touch on all of these topics today. I'm mainly going to focus on the taxation issues. As a result of the meetings, the phone meetings that I had after my last webinar, these seem to be the major issues that practitioners needed to get their head around. And it also created the greatest diversity of whether or not someone would consider incorporating or not. So in terms of looking at the tax issues and all the issues, I suppose, for an ILP, when you incorporate your practice, these are just a list of all the different sorts of things you need to consider. First of all, it provides you with limited liability. You get a tax rate of 30%. Your shareholder can be a trust, which allows you to income split. Your debt reduction, we'll touch on this today from an individual perspective. Your debt reduction can happen at based on 70% of your after-tax income, whereas in your own hands, if you're making more than $180,000 a year, your debt reduction will be after paying 46.5% tax, so 53.5% after-tax income. There is an ability to access for most principals, small business CGT concessions, but it's a very technical area that applies differently to different practices and different principals. The ability to better utilise concessional super contributions, get simple succession planning in your business by having an ILP, and there's an ability in some instances to convert non-tax deductible debt to deductible debt. So with that as a context, I now just want to really focus on and give you a better indication of some of the issues and from a taxation perspective and how they apply to incorporating your legal practice. But remember, this is from a principal's perspective, so we're not going to be looking so much here at what happens within the ILP itself. So the first point is that the original taxing point of income will be taxed at 30% in the company, as opposed to your marginal rates of tax for a principal, which vary from 0% through to 45%, the highest marginal tax rate plus Medicare levy. It allows you to income split from 0% through to 37% tax environment and the 45% above that. Maybe an ability to convert non-deductible debt, which then allows you to claim tax deductions for interest on that debt. The benefit of structuring your affairs so that you're able to increase the amount of benefits that you have within a superannuation environment allows you to take advantage of either 0% tax rate if you're over 55 years old within super, or 15% tax rate if you are not over 55 years old. And also there's an opportunity in looking at how if you operate your practice from your own business premises, or whether or not you're considering acquiring business premises. In considering an ILP restructure, the application of how you restructure your premises into super can provide you with some significant benefits. So I'm going to touch on all of those issues today so that you get a bit of an overview of some of the issues that you need to consider and the opportunities that exist for you when you're considering an ILP. Couple of other tax issues to address. There's the small business capital gains tax concessions versus a rollover. I'm not really going to spend a great deal of time on this at all. All I'm really going to say is that if you're restructuring your business from a sole principal or a partnership of individuals or from trust into an ILP, you'll need to address the capital gains tax issues, but there's an ability for the small business CGT concessions to apply and also CGT rollover, so that you shouldn't have any capital gains tax to pay on the restructure of your business. What I'm also going to touch on is just give you a very quick overview of what the cash flow issues are in relation to PAYG instalments and the payment of your company tax and individual tax over that transition period of the first 2 years when you pay your PAYG, when you first incorporate. So just another very quick poll. I'm just wanting to get a bit of an idea, first of all, of what your current structure is in your practice. So if you could just take a moment to just do a quick vote there. Almost there. A couple more people to go. Thank you very much. So with our poll, there is 39% operating as a sole trader, 32% as a partnership of individuals. There's 10% that are a partnership of trusts, 6% a partnership of trusts and individuals. So it's a mixture, and then there are 13% that are an ILP. So thanks for that. We've got a really good mix, there. So what I'm just going to run through now is an overview of how the different marginal rates of tax and tax rates work for companies' superannuation funds. So just a very, very quick overview. Because what happens from a tax planning perspective when you're looking at whether or not you should incorporate, you need to get an idea of what the differences are in terms of how the tax works, in the corporate environment and the superannuation environment from a personal perspective, and how this applies to you. As an overriding comment, tax planning is often done in relation to each financial year, where people take the view, let's have a look at what our profit's going to be or our taxable income's going to be, and think about, well, what extra deductions can we get, what other products can we acquire, how can we defer income. But really, those type of things are a deferral of income often, and often come with risk. What I call tax planning is really making sure you've got the structure right, so that the assets are owned in the right entities and that the income is being received or distributed to the right entities, with the overall impact being paying the lowest marginal rate of tax. So just to give you a very quick overview, the way the marginal rates of tax work is like that. So you've got 15% tax rate, 30% tax rate, 37 and 45. So depending on how you pay tax in your personal name, depending where your income sits, you'll pay tax at all or some of those marginal rates of tax. For a company, it pays its tax at a flat rate of 30%. And I'll show you on the next slide that a company really is just a deferral of tax because ultimately those profits get taxed to the individuals or the shareholders. But companies pay tax at a 30% rate. Superannuation funds pay tax at 15%. So when you're looking at your strategy around how you pay the lowest rate of tax, you should be looking at it from an overall consolidated perspective and trying to get your income landing in the entities in a legal way and an appropriately structured way, so that your average rate of tax is the least amount possible. From an individual's perspective, and we're looking at marginal tax rates versus a company tax rates, ultimately when you're looking at how that income gets taxed when it's paid out of a company as a dividend, as an individual you can earn about $140,000 of income and you still pay tax purely at that 30% average tax rate. So even though the income in your name is greater than $80,000 is taxed at 37%, your lower rates of tax average it out so that you can earn $140,000 of income before you pay more than 30% tax. So if you think out from a tax perspective, if you've got less than $140,000, from an ILP perspective, and if you've got no one to share your income with, incorporation might not be a great idea. But if you've got the ability to share your income over a range of beneficiaries or other people, then the lower the amount of income that you have in your hands that's less than $140,000, your average rate of tax is going to be less than 30 in the company. So there's great benefit in doing it. I referred to a point before about a company only being a flow-through vehicle. So ultimately, if your practice is within a company structure, the profits of that company get taxed at 30%. Now, if they're being taxed at 30%, the company pays that and then will pay out a dividend to a shareholder. And then the shareholder, depending on who they are, will be taxed on those dividends. Now, if the shareholder's a trust, what will happen on an annual basis is that that trust will make a distribution of income. So those profits or those dividends will then be distributed to beneficiaries. Those beneficiaries then pay tax at their normal marginal rates of tax, but they then get a credit for the 30% tax paid by the company. So if I just go back a slide, so you can see there that if the average rate of tax that's payable by an individual, if that income is less than 140,000 or thereabouts, then the average rate of tax will be less than 30, which means the ultimate rate of tax that is paid on those profits that are earned in the company will be less than 30%, simply because you get a tax credit. That's called the dividend imputation system, and those credits are called franking credits. So it's very important when you're considering how you're going to structure your ILP, consider who those shareholders are going to be. So if you just restructured your business from an individual sole practitioner into, or a partnership of individuals, and the shareholders of your ILP were those same individuals, there's only going to be a deferral of tax for a period of time. It's not actually going to give you any real net tax reduction, simply because it ends up getting taxed to you in your own names. But if you've got a shareholder as an individual, as the shareholder, so you've got a trust as a shareholder, then the beneficiaries will be the beneficiaries of that trust, which may allow you to allocate your share of those profits between 2, 3 or more beneficiaries. So let's just take that through a little bit of a scenario. Let's say that your share of profit before your principal's salary, so it's just the amount of profit that you get, your share of profit that you have in the practice is $300,000. In a traditional practice structure, you'll either be a sole trader, or you may have principals in a partnership of individuals. So in any event, what I'm saying here is the principals are being taxed as individuals, but what you also may have is you may have a service entity, where that service entity is quite limited in terms of the level of profits that it can receive or be allocated, simply because of the ATO's view on service trust and its view on markups. So I'm just assuming here there's 10% of those practice profits would be able to be allocated to associates of those principals, spouses and so on. Compared to an ILP, where the ILP has a trust shareholder, and in this example I'm just saying that those profits are able to be split 50-50 between two beneficiaries that have no other income. So it's a comparison between effectively receiving 10% of practice profits for that associate and 50% of those practice profits. In a traditional practice, the overall tax bill for that structure for the family would be $103,150 on that $300,000 worth of profit. Where in an ILP with a trust structure, by being able to split your incomes, that income tax on that same amount of income reduces down to $91,400. So if I've done my maths right, the additional after-tax cash flow that you receive from having your affairs appropriately structured is $11,750. So if you're somebody who's starting off or considering starting off your practice, and you're considering whether or not to do that as an individual or an ILP, provided you meet the rules that allow you to split your income, we touched on those last time, and they're the rules around personal exertion income versus business profits, then provided you've got more people that you can split your income with, you would structure your business this way every time, so that you've got that ability to allocate income to others to reduce the amount of tax that you pay. So you can see there, simply by appropriate structuring, you pay less tax, and we're all entitled to do that. What we're talking about here is just having the right structure to pay the least amount of tax, as well as all the other benefits that come with operating your business through an ILP. So you can see then structurally how this works. Just going to move on next to looking at your debt strategy as a principle in the legal practice. And I just want to show you how having non-deductible debt versus deductible debt can be a major issue that can provide you with some major upside if you structure your debt appropriately in relation to your personal affairs and for your business. So just a quick question. Another little poll. Have you got any non-deductible debt? Yes or no? Almost there. A couple more people to answer. Thank you very much. So I'll just close that. So 47% of the participants in today's webinar have some non-deductible debt, and 53% don't. So congratulations, all of you who don't have any deductible debt. You've got some of your strategy there working well for you. But for those of you who do have some tax deductible debt, let me just take you through an example of what by getting your debt structured appropriately, what that impact that has on your business. Now, put to one side whether or not you incorporate or not. What a lot of people don't do is they don't actually gear their practices up to fund their working capital. So as a minimum, if you're carrying work in progress and you're carrying debtors in your business, you're a sole practitioner or a partnership of individuals, you have an ability to finance the growth and timing of those assets. So let's say you're carrying $300,000 of WIP and debtors you've got a personal debt out to one side. Then those WIP and debtors are assets of the business, and you're able to go and borrow money to fund that asset. So it's something to consider, even if you don't go and restructure or establish your business in an incorporated legal practice. So how does non-deductible versus deductible debt work? So first of all, for non-deductible debt, you earn your income, you then pay your tax on that income, and then out of what's left from your after-tax income, you pay your principal and interest loan repayments. The difference with deductible debt is that you earn the income, so let's say you earn the same amount of income, you then pay your interest, effectively getting a tax deduction for it, so it reduces your income, then you pay your tax. So if we were to, and then out of what's left after your income minus your tax, you then pay your repayments. So just to hop back here to our tax plan, if you've got $140,000 worth of income and you get taxed on that, you're going to pay more tax than if that income was, say, $120,000 after paying the same amount of interest. So the interest to the bank might be exactly the same dollars, but you pay less tax because you get a tax deduction. So just to give you some numbers around that, if we look at the cash flow impact of having your debt appropriately structured as tax deductible debt instead of non-deductible debt. And so we've got a loan for $300,000. You're going to pay it off principal and interest over 10 years, so you're $42,732 per annum of repayments. Interest is at 7.5%. If we use those previous profit assumptions around tax, it produced in that example of income, what happens from a tax perspective of getting your shareholding structure right. The average rate of tax on the principal's income in that instance was 36.7%. That is where the principal was getting taxed on 90% of the income. So the impact from a debt comparison in year one. So first of all, if you've got non-deductible debt, you've got to earn $67,512 to pay the tax at that average rate of $25,780, to have enough after-tax cash to pay your principal and interest repayments of just over $42,000. So on that $67,500 income you earn, your cash flow that you've got after paying your tax and after paying your non-deductible interest and your principal repayments is zero. Whereas if you had that same $300,000, if it was tax deductible to you, then you claim that interest as a tax deduction. You can see your tax there reduces from $25,780 to $13,717, which provides you with after-tax cash of $53,795, and a P&I repayments are exactly the same because it's the same 300 grand, It's the same at 7.5%. Their principal and interest repayments are the same, but what it does, it provides you with free cash flow of $11,063. So that's working on the basis that you have that debt structured without even incorporating. So if you were to incorporate your business, I'm just going to show you a calculator here that will show you the impact or the free after-tax cash flow and the tax savings that get produced based on also restructuring into an ILP, but also making additional super contributions, but also if you apply your debt your extra cash flow to a debt reduction as well. So a few points to put in here. So first of all, there's a bunch of assumptions that you can see that this calculator is based on. So let's say as an individual, your share of profit is $300,000. So just to be consistent with all of the examples that I've used so far, saying that share of profit is just for one equity partner. So if you had two equity partners, have a profit of $600,000, your net profit per partner would be the same. We've got 10% of that profit being distributed to associates and related parties via service entities, which means that the principal has the principal's got a share of profit that's taxed to them of $270,000. If you were to value this business and it had a 2 times valuation multiple, you might value the goodwill of the business at $300,000. So all that calculation is, what's the profit for the business? Take out $150,000 salary for that principal and multiply that by 2 to produce a goodwill valuation. And we're just saying, all I'm saying here is that if you had a $300,000 goodwill valuation, if you were to transfer that into a business, into an ILP, then you may be able to restructure some of your debt into that company so that that debt then becomes a tax deductible debt. Or alternatively, if you've got $300,000 worth of WIP and debtors, you can restructure debt in there to fund that. So we're just going to assume here that you're able to restructure $300,000 of your debt. That gives you your principal and interest repayments over 10 years at 7.5% of $427,326, with a pre-tax income required to pay that of $67,512. So if we go back to those numbers that I threw up on the screen previously, that's the income. If the tax rate for that 10% income was 13.5%, so this is if you didn't restructure, and just to compare the tax on that income paid by associates, it's going to be 13.5%. And if you're able to split your income over 2 people under an ILP with an appropriate shareholding structure, the impact for you is that after 5 years there is additional free after-tax cash flow of $50,000. So if you can remember, that cash flow was about $11,000 under that 2 scenarios. Here it's $50,000. That's simply because your interest reduces and so your tax increases slightly. So over just a 5-year period, you're $50,000 ahead. That number will grow and grow over the term of a loan of 10 years. If merely by restructuring the business into an ILP with the ability to split your income over two different beneficiaries, then in year 1 there's a $7,700 net tax saving because of the ability to split your income. Stamp duty on $300,000 is $8,325. So year 1, the net cost to you of restructuring from an after-tax versus stamp duty perspective is nil. It's near enough to nil. If you were to also have the ability to restructure your debt, then with the ability to claim interest as a tax deduction, there's $19,975 of tax savings just in year 1, which goes out to $89,178 over a 10-year period. If you apply your free after-tax cash flow that you've got, so that $11,000, that $50,000, you apply that into super as a tax deductible contribution, then your after-tax cash flows overall have improved, even though you've got that money put into super, has improved by 81,000. Over a 10-year period, it's 96,000. Oh, sorry, I think that should be 5-year period, not a 10-year period there. So over a 5-year period, that's $96,000. So you can see that appropriate structuring, getting the income ending up being taxed in the right hands, having your debt structured within your company, has a significant impact on the amount of your after-tax income and after-tax cash flow that you're left with. So it's very much worthwhile. What you've got to do is you've got to run all of these numbers on your personal situation to see what the impact actually is. So the next thing I want to have a look at is just whether or not there's opportunities for people in restructuring their business premises or ownership of their business premises into self-managed super fund. I raise this as a point, and I want to run through this simply because if the small business capital gains tax exemptions apply to you and you're under 55 years of age, then 25% of any capital gain that you make on that capital gain will need to be either have tax paid on it at some point in time or be put into superannuation if you're under 55. If you're over 55, then you don't have to put it into super. But if you're under 55, you need to get it into super, and sometimes this is prohibitive for people finding that cash flow to fund a contribution. But one way of doing it is if you own business premises and you've got those business premises those business premises are from which you operate your practice, then by restructuring that equity into super, you can make effectively in specie contributions or roll that money into super that you otherwise would have had for your capital gains tax. So let me just take you through this quickly. So these are under the self-managed superannuation borrowing provisions of SIS. Off the top of my head, I think it's section 67A. Some of you will be familiar with these, but if you own a business and you've got tax that you're paying of more than 15%, it's very unlikely that there isn't going to be some upside for you in owning your premises within a self-managed superannuation fund environment. I'll run through that with you now. So how it works. Basically you go to the bank and you borrow some money, and that money generally will be equal to the money that you already owe on those business premises. So all you're doing is restructuring that debt out of the property owner's name into super. You then within super you may have cash and borrowing, and I'm assuming here that within the superannuation, in the example, you'll have say $300,000 worth of cash in super. So that money is then combined, the borrowing and the cash, and is paid to the property owner to purchase the property. So the property is then transferred into super. You've got to make sure here that that structurally is done correctly in accordance with the rules of SIS. Then what happens is the property owner repays to the bank that money that they received, some of that money that they received, which is effectively going to be just restructuring that same amount of debt out of the property owner's name into self-managed super. Once that is done, there would be some cash in the property owner's hands, being effectively that equity has been transferred into super. So there's a couple of options there. You can use that to fund contributions, either of a concessional nature. For those over 50, this is the last year we'll be able to put in $50,000 each. I shouldn't say we, I'm not over 50, but you'll be able to put in $50,000 each. But also that capital gains tax amount, both on this property and also that 25% of the capital gain on this property, but also the 25% on your restructure of goodwill, that equity can be rolled into super to deal with that tax-free. So that's basically how that structure works. So very quickly, you borrow money if within the superannuation environment from a bank, pretty much equal to the amount of money that you've got on your property outside. The super fund borrows that, combines it with its existing cash, puts that into, buys the property from the property owner pays out the bank, and then you fund the equity, the additional equity via super contributions and CGT retirement exemption amounts. Very quick example. Got a property worth $800,000. Original cost of that property is $400,000. We've got a loan of interest only of 400 grand, cash in super of 300. So the outcomes, if those were the facts, that is that the debt can be paid off. Oh, it's in less than 5 years. Sorry, that should be less than 5 years, and that's simply because that debt gets funded out of super contributions and rent that is being taken out of a higher tax rate and put into a 15% tax environment, or depending on your age, it may even be at a 0% tax environment. So effectively, you get a tax saving on your principal of $126,000. So if you're paying tax at a 46.5% rate, to clear that principal, you've got a 30% tax saving, being the difference, 31.5 being the difference between 46.5% and 15% in the tax in the super fund. Also, if you wanted to keep that $300,000 cash that you've got by selling the property and apply that to clear non-deductible debt, then by no longer having to pay that interest out of after-tax income on that non-deductible debt, you get an additional saving of about $110,000. I've got to say though, when you're looking at restructuring or ownership of property in super business premises, in super, using gearing strategies or even without gearing strategies, you've got to make sure that you've got absolutely strict compliance with the Income Tax Assessment Acts of 36 and 97 and also the SIS Act. By doing this incorrectly, you could cause your self-managed super fund to be non-compliant, which could put 45% of those assets at risk. So just a very quick poll before we move on. I'd just like to get an idea of how many of the listeners today have got a business premises that they own, that they operate their practices out of. Fantastic. So there's about 28% of you that you may, if you don't already have your premises structured within superannuation, you may wish to consider this as a strategy in terms of your overall financially well organised strategy so that you're able to retain more of your after-tax income. And an additional point is that if you own your premises within superannuation, there's also another layer of asset protection in there. So the last point I want to cover off today is just having a look at the how the PAYG instalment system works. Basically, the way PAYG works, as you know, it's based on, you pay quarterly instalments based on your last tax return. So if you were to restructure your business into an ILP on 1 July 12, then I've just mapped out here the timing of your principal, your PAYG instalments. So on the if you're as an individual, on the 28th of July, you would pay your last 2011-12 PAYG instalment. So that's right there. On you then no longer have any trading profits in your own in your own names. And I'm also assuming here that you're paying tax on a cash basis. So what then happens within the 2012-13 year, so in this period, the WIP is converted and the debtors are collected. So that will form the basis of your taxable income for that year. And also that will fund, you'll use that to fund some, if not all, of your living expenses. So if you look at what your WIP and debtors were at the end of 30th of June 2012, it's most likely that that will be your income that you are taxed on for your PAYG instalments for that following year. So what you're able to do then is to either vary your PAYG instalments down or pay it maybe based on your percentage rate of your income. Usually that results in a lower amount of actual tax that's needed to be paid in that time. With the company, the income that's earned there in the 2012-13 year, it isn't required to be paid until the company lodges its tax return. So assuming that the company lodges its tax return on the 15th of May, sorry, that should be 2014, I just better correct these slides, but it's payable on 15th of May 2014, you effectively need to retain your cash and save it, but you get the benefit of holding on to that cash over a longer period, so almost 2 years. Your balance of your personal tax then gets paid for 13 years. So, paid on the June the 6th, 2014. So effectively, what restructuring into a company does, it gives you a bit of a cash flow holiday. It doesn't mean you don't have to pay the tax. You've got to be very mindful and wary about that and save for it, because there's nothing worse than getting out to 15th of May 2014 and you've got this big tax bill that's payable and you haven't saved for it. Mind you, that will only be at the 30%. After that, after say 1st July 2013, you might start paying some of those fully franked dividends out. But you need to be very mindful of that. So that's really a quick overview of some of the issues that you need to understand and address from a personal perspective in considering whether or not you should incorporate. Just as I did last time, I'm offering for the first 15 people to email me today to book in a 45-minute one-on-one telephone meeting to discuss these opportunities and the application of this to your practice and to you as individuals. Within about 45 minutes after the completion of this seminar, and we've got nearly 100 people on the line again today, those appointments were filled. And basically, we'll just take 45 minutes to talk specifically about how this applies to you and your practice and your personal situation. So the other thing is I've decided to combine the last two webinars into one. Pretty much because when I look at the upside for the practice, there's probably only about 15 minutes worth of topic to talk about. So where I had two webinars, I'm going to be combining those into just one, calling it the upside for the practice and the real long-term return, where we'll bring together both the practice and the individual principal upside and combine those to show how you can take advantage of structuring your whole affairs appropriately and what that means for your long-term position. So again, thank you very much. For all those people who have registered for the other one, the fourth one, we'll be in contact and just give you a reminder if you haven't already to have to register for the last one, for the next one on the 17th of May. So for everybody, thank you very much for your attendance today. I hope you've got some further valuable insight into it. The tax area is a very complex area, and you really need to have a look at this individually. So please drop me an email and schedule in your 45-minute free meeting. It's obligation and commitment free. But even if you wanted to just drop me an email with any other questions or give me a call, please do so. Hop on our website to register for the following webinar next month, or also have a look at our website, elliotsgroup.com.au. You may also like to have a read through some of the blogs that I've posted up there specifically in relation to law firms. So thank you very much, and I hope you have a great afternoon. Thank you.
The organizer